technical indicators, like RSI MACD, and moving averages are often presented to beginners as if they are decision engines, tools that will tell you when to buy and when to sell, if you just learn the settings correctly. But that misunderstanding is one of the fastest ways to turn useful instruments into sources of confusion and overtrading, because indicators do not create edge on their own. They describe conditions, and conditions only become actionable when you understand context, behavior, and risk. I learned this lesson the expensive way loading my charts with indicators early in my career, believing that more confirmation meant more certainty, only to discover that indicators were not contradicting each other because the market was confusing. They were contradicting each other because I was asking them the wrong questions. The most important thing to understand before we talk about any specific indicator is this: all technical indicators are derived from price and time. They are transformations of information you already see on the chart, not independent sources of truth. That does not make them useless, but it does mean they are always late by definition. Their value is not in prediction, but in framing. When you use indicators to confirm what you want to do, they will mislead you. When you use them to contextualize what price is doing, they can become powerful filters that keep you out of bad trades. Let's start with moving averages, because they are the simplest and most abused of all. A moving average is nothing more than the average price over a chosen period plotted forward in time. It smooths noise. That's it. It does not predict reversals, and it does not create support or resistance by itself. What it does do is help you see direction and pace. When price is consistently above a rising moving average, the market is telling you that buyers are in control over that time frame. When price is below a falling moving average, sellers dominate. The mistake beginners make is treating moving average crossovers as signals instead of understanding them as descriptions of alignment. By the time two averages cross, the move is already well underway. The real value is not the cross, it is the slope and how price behaves around it. I learned to use moving averages not as triggers, but as environment markers. Is the market trending cleanly or chopping sideways? Are pullbacks shallow or deep relative to the average? Is price respecting the average or slicing through it without reaction? These observations matter far more than whether price touched the line exactly. When I stopped trying to trade the moving average and started using it to decide which strategies were allowed, my results improved immediately. Trend strategies in trending environments. Range strategies when moving averages flatten and overlap. The indicator did not give me trades. It told me what not to trade. The Relative Strength Index RSI is next, and it is probably the most misunderstood indicator beginners encounter. RSI measures momentum by comparing the magnitude of recent gains to recent losses over a set period. It oscillates between 0 and 100, and beginners are taught simple rules. Above 70 is overbought, below 30 is oversold. This is where trouble begins. Markets can stay overbought for months in strong trends and oversold for just moments in downtrends. Trading RSI mechanically against strong moves is how many beginners learn what it feels like to fight momentum with logic. The real value of RSI is not overbought and oversold, it is regime identification. In strong uptrends, RSI tends to hold above 40-50 and peak near 60-80. In downtrends, it tends to hold below 60 and bottom near 20-40. This range shift tells you who is in control. When RSI fails to reach previous highs during rallies or previous lows during sell-offs, momentum is waning. That information is subtle, but it is far more useful than a single overbought reading. RSI divergence, when price makes a new high but RSI does not, can warn of exhaustion, but only when it appears in the right context, after extended moves and near key levels. Used casually, RSI creates false confidence. Used patiently, it provides early warnings that encourage restraint. The MACD, or moving average. Convergence-divergence combines elements of trend and momentum. It measures the distance between two moving averages and compares that distance to its own average. Beginners often treat impact crossovers as buy and sell signals, which is understandable but incomplete. Like moving averages, MACD crossovers occur after momentum has already shifted. Their real value lies in understanding acceleration and deceleration. When MACD expands strongly, momentum is building. When it compresses, momentum is fading. Histogram behavior often matters more than the signal line cross itself. I learned to use MACD as a way to stay out of trouble rather than to get into trades. When price looked tempting, but MACD showed declining momentum or failed expansions, I became cautious. When price consolidated and MACD reset without turning deeply negative, it suggested healthy digestion rather than reversal. Again, the indicator did not tell me what to do. It told me when to slow down or stay patient. One of the most important lessons across all indicators is this: indicators work best when they agree with price structure, not when they contradict it. If structure is bullish and indicators are supportive, confidence increases slightly. If structure is bullish, but indicators diverge, size comes down, or trades are avoided. Indicators should adjust risk, not justify action. This distinction is subtle but critical. Indicators are governors, not engines. Another trap beginners fall into is indicator stacking. Adding RSI, MACD, moving averages, stochastic, and more does not increase accuracy. It increases hesitation. Many indicators measure similar things in different ways. When you add too many, you are effectively asking the same question repeatedly and hoping for certainty. Markets do not offer certainty. They offer probability. One or two indicators used consistently and understood deeply outperform complex indicator cocktails almost every time. Timeframe alignment also matters. An RSI divergence on a 5-minute chart is noise against a daily trend. A MACD rollover on a weekly chart can matter for months. Indicators inherit the time frame you apply them to. Beginners often sabotage themselves by reacting to lower time frame indicator signals while holding higher time frame ideas. The time frame that defines your trade is the time frame that defines which indicators matter. Everything else is commentary. Over the years, I noticed that traders who truly understood indicators stopped talking about settings. They talked about behavior. They said things like, momentum is weakening, trend is intact, volatility is compressing. Indicators became a language, not a rule book. That shift is what separates tools from toys. And this is where we need to continue next, because understanding what RSI, MACD, and moving averages are is only the foundation. The real skill is learning how to apply them together in a simple, non-conflicting way that supports decision-making instead of paralyzing it. How to decide which indicator matters in which environment, and how to avoid the common beginner mistake of treating indicators as trade triggers rather than context filters. And that transition from explanation into application is exactly where we go next. As this sentence carries forward into building a clean, beginner-friendly indicator framework you can actually use without overtrading or second-guessing yourself in live markets. And that is where we continue next, by reducing everything into a single coherent decision flow instead of 3 separate opinions arguing on your chart, because indicators only become useful when each one has a role and none of them are allowed to overstep it. The simplest framework I ever found, and the one I still rely on, assigns moving averages the job of environment, RSI, the job of momentum, health, and MACD, the job of timing, patience, and nothing more. When each indicator stays in its lane, clarity replaces clutter. I start every analysis with the moving average, usually a simple or exponential average that represents my primary time frame. I am not asking it where to enter. I am asking one question only: is the market trending or not? If the average is rising and price is holding above it, with shallow pullbacks, trend strategies are allowed, and counter-trend ideas are banned. If the average is flat and price chops through it repeatedly, trend strategies are forbidden and range logic dominates. This single step eliminates half of all bad trades before I ever look at RSI or MACD. The moving average is not a signal, it is a gatekeeper. Once the environment is defined, RSI tells me whether momentum agrees with that environment. In an uptrend, I want to see RSI hold above the midline and recycle higher, not collapse into oversold territory. If RSI cannot sustain bullish ranges, that is not an entry signal, it is a warning. I either reduce size demand, better structure, or stand aside. In ranges, RSI extremes matter more, but only at range boundaries. I never trade RSI in isolation. I use it to answer a single question: is momentum behaving the way it should if my market thesis is correct? If not, patience replaces action. Only after those two agree do I glance at MACD, and even then, I am not hunting crosses. I am watching shape and rhythm. Is momentum expanding or compressing? Is MACD resetting during consolidation instead of rolling deeply negative? Is the histogram contracting while price holds structure? These behaviors tell me whether waiting makes sense. MACD is my patience indicator. When MACD is stretched, I wait. When it resets constructively, I prepare. This prevents chasing and helps me enter when emotion has cooled rather than peaked. The critical rule is this: if indicators disagree, I do nothing. Beginners think disagreement means confusion. Professionals know it means risk. When moving averages say trend, RSI says weakness, and MACD says exhaustion, the market is telling you that conditions are transitioning. Transitions are where most losses occur. Cash is the correct position when your tools stop agreeing. This rule alone saved me years of frustration because it replaced forced interpretation with acceptance. Another important discipline is never stacking indicators to justify a trade. If you find yourself saying, RSI is oversold, but MACD is crossing, and price is at the average, so it should bounce stop. That sentence is negotiation, not analysis. Each indicator should disqualify trades more often than it qualifies them. If your indicators are making you trade more, not less, they are being misused. Time frame alignment remains non-negotiable. The indicators you trust must live on the same time frame as your decision. A daily trend with a 5-minute RSI signal is noise pretending to be information. When I aligned indicators strictly to my execution horizon, my psychology improved immediately. Fewer conflicting signals meant fewer second guesses, and fewer second guesses meant cleaner execution. Over time, you will notice something subtle. The more consistently you apply this framework, the less you look at indicators. They fade into the background. You begin to feel when momentum is healthy or when trend is weakening before you consciously check RSI or MACD. That is not intuition replacing discipline. It is discipline training perception. Indicators teach you what to notice until you no longer need to be reminded constantly. The final lesson is this: indicators are not there to make you confident. They are there to make you cautious at the right times. Confidence comes from process consistency, not from indicator alignment. When you use RSI MACD and moving averages as filters that protect you from bad trades rather than engines that push you into action, they become allies instead of temptations. And that is how technical indicators stop being confusing and start being useful. Simple roles, clear hierarchy, no negotiation. If this framework helped you see indicators differently, I invite you to subscribe to the channel so you can keep building clarity instead of clutter, and leave a comment sharing which indicator you tend to misuse most, because recognizing that habit is often the first step toward turning these tools into quiet supports rather than loud distractions in your trading.